Should you finance, lease, or outright purchase a car? This is a top 3 question I get asked all the time. I'm Davey Mack and I run an award-winning accounting firm called Box Advisory Services. We're a chartered accounting firm that specializes in small businesses, and I've been an accountant for the last 17 years. This video is a private consulting session I had with my clients. I explained the 3 options that most businesses consider when looking to purchase a vehicle or an asset. I also answer a range of questions so that you can understand real life scenarios and how to think about it. There isn't one option that's better than the other. It's about picking the one that's best for you and your circumstance. So I've covered the pros and the cons of each option, along with specific examples with real calculations. Let's jump into it. Let's start with leasing, guys. So when you lease a car or equipment, leasing allows you to essentially rent the equipment. People get it very confused. Sometimes they see equipment lease, they don't know what leasing is compared to financing. Leasing means that you actually don't own the equipment. So the lender or the person that's leasing it to you is the one that purchases the equipment on your behalf. They own it, they have the rights to it, but they then lease it to you, and which you pay monthly or weekly rent to use that equipment. At the end of the agreement, you don't actually own the equipment, which could be a good and bad thing. The reason why you might not want to own it is because it's something that only lasts for 1 or 2 years, and so you would normally upgrade into another equipment after that. So you most likely don't want to take the risk of owning this equipment that's outdated. So that's why people generally like to rent. The good thing also is that you don't normally need to put a deposit down to lease the equipment, which means you just pay a monthly payment on the short term, and you keep that equipment for maybe 6 months, 12 months or maybe even 1 to 2 years. And that's what leasing is. And it's quite different when it comes to taxes and how to record it, because you don't actually physically own the equipment. The lender or the person that's renting it to you is the one that owns it. In terms of finance, it's very different. You actually own the vehicle or the equipment. So that means that you're borrowing money from a lender. The lender lends you that money, charges you interest, and then you have to usually put a big deposit down. And the reason why you have to put a deposit down is because they want to make sure they manage their risk. So as you know, when you buy a car, most likely when it comes out of the dealership, the value goes down by 10-20%. And so therefore, they usually want you to put down a deposit of 10-20%. So if they have to sell the car and they come up with the value of the car and sell it, they at least have the deposit as well as the sale of the car proceeds to cover the loan plus the interest and the cost of having it. Yeah, so that's what they have to do in terms of making sure that they manage their risk as a lender. So as I mentioned, you own it outright and the deposit normally required. Sometimes as well, you can negotiate having a balloon payment at the end. A balloon payment is basically, you pay 10-20% to clear the loan. And that's allowed generally because at the end of the life cycle of the loan, the equipment or the car has a value that you can probably resell. And so that balloon is usually an estimated value of something similar or under the value of what the resale value is. So if you sell it, you can just take that proceeds and pay off the loan as well. Or they can just take the car if it's a dealership. So a lease is quite similar. You probably do have it outright. At the end of the lease, you can probably buy it outright as well at a cheaper value. All right, last option is buying it outright. Pretty simple. Just you buy the equipment or car and you pay for it outright. So they're the options that most people have. There's sometimes some people do ask about novated leases, but I usually don't recommend novated leases at all for clients that run their own businesses. Novated leases is actually for employees. The benefit is for employees. The problem with novated leases is basically the employee doesn't own the car. The employer or the company that is employing the employee is the one that owns the car and then rents it over to the employee. So when you do something like that, it's generally used for work, but however, it's used for personal use as well. And there's FBT requirements. And so you're paying about 47% tax on fringe benefits tax. And I'll go into more detail of that, but that doesn't actually work out that well for you because there's actually better tax concessions for you to own the company car in your business name rather than in and then just claim all the expenses in your business name rather than trying to claim it in your employee's name. Novated leases allows the employee to claim some sort of expenses and after tax dollars, and it ends up being that the company pays the tax for the employee because it's for the personal use, and it's actually not that beneficial. Yeah, you rather just get to claim the tax concessions in the company and just leave it as that and don't include the employee in it because that employee is most likely you, the director. Okay, now let's go into pros and cons. Leasing has its pros. Leasing means that there is no upfront cost usually. We have a printer in the office. I bought our printer outright, but generally accountants would lease a printer because they don't want to, pay $5,000 for a printer. They would just pay for it on a monthly basis for the time of use. And then if I ever move offices, I'll just return the equipment. Or if I just, stop working, then I'll just return the equipment. So there's fixed payments. It's easy to upgrade. So you don't need to upgrade, obviously, to a motor vehicle. You got to upgrade the printer as well. The problem with printers is that there's a lot of apparently new tech. Apparently, I think it just prints paper, but apparently there's a lot of new tech. And as a result that you have to keep constantly upgrading the printer every now and then because it prints faster, it scans faster. Believe it or not, people actually care about how fast it scans and print. It's weird, but yeah. And then also you get to claim the GST on each payment that you make. So that's the pro of having lease payments. So let's just say that you spend, $500 a month on a printer, well, $550, sorry, a month, you get to claim $50 GST every time you spend that $550. And that gets claimed on your quarterly basis. You get the 10% GST. It also frees up cash flow, so you don't have to buy it outright, obviously. So obviously spending $2,000 to $5,000 to buy a printer, quite expensive. You can just, spend, $200, $500 a month to just rent it instead. Okay, the cons, however, is that you don't actually own the asset. And if you do try to terminate the agreement earlier than usual, you might have a termination fee, and they might charge you the full lease fees for the whole 2 years or 1 year that they have. And the reason why they do that is because they're running a business. They do want to make money through their lease fees. And so if you end it early, then they're not going to really make that much money on it. So they usually charge an early termination fee for leases. You also can't claim the thing outright because you don't own it. Whereas when you finance or buy it outright, say it's a car, it's worth $50,000, you get to depreciate the car because you own it. You get to depreciate the car in the finance situation as well because you own it. Whereas in this case here, you can't depreciate it because you don't own it. What you can do is only claim each payment as you go. So if you make 3 payments in the last quarter, you only get to claim the 3 payments rather than you owning outright and get to claim the whole thing up front. Last thing is obviously you have to pay a lease fee. So what I mean by lease fee is the cost of setting up the lease. And they usually charge an extra fee per month to make sure that they make a profit out of it. So good examples is the ones I mentioned: forklifts, printers, equipment. I had a client call me when I was in Japan, and he was talking about buying a forklift, and he wasn't sure if he should lease it or buy it outright. He didn't really want to finance it because he didn't want to pay the interest, and so he ended up buying it outright. That was his decision. But the options were that he knew that he didn't think he needed to upgrade his vehicle, like the forklift, and he didn't want to claim it as we go. He just wanted to claim the whole thing outright. And during that time, this was a couple of years ago during COVID. I can't remember if it was just starting of COVID or when the lockdown rules got relaxed, but then allowed you to claim up to 150K of a vehicle or equipment. So therefore, in that case, he could claim the whole thing for the first year. So that's why he opted to buy it outright instead. Okay, so let me explain financing outright real quickly. Financing, you own it outright. You have the whole ownership. You also get the tax benefits of claiming the interest as well as the depreciation. So depreciation is quite easy. Just to quickly explain, is that when you own a car and you buy it outright, say you buy the car for $50,000, if you were to use the normal general depreciation rules, you can't claim the 50,000 upfront. You get to claim it over like the life cycle of it. The life cycle for a car, usually the ATO prefers, is it's about 8 years. So you get to claim $6,250 per year. There are different types of depreciation methods. You could depreciate more earlier in the years, where there's a rule where you can do like general pool, where you can claim 30% upfront. So you get to claim the 15,000 upfront for the first year. And then after that, it just diminishes like over time. So you get to claim a small amount over the years go by. So in the last few years of the life cycle, it's pretty much a worn out vehicle or whatever it is. So you only get to claim like what, $2,000, $3,000 a year, rather than, 6,000 or 15K. So there are different methods. So that's what depreciation is. You get to claim that. However, a lot of people get confused. If you were to claim this back, just so you know, on a $50,000 car, you spend $50,000 in cash, you don't actually get $6,000 or $15,000 back. Okay, just want to make sure that you understand that you don't get the $6,000 or $15,000 back. You get the percentage in taxes back. So if you're buying it in a company, it's actually 25%. So what you're really getting back is the $3,750 on the first. If you're using the general pool, which depreciation is 15K, you only actually get 25% of what your depreciation is. Same versus the 6,000, you only get 25% of this. So what you're physically getting back on spending 50K is this for the first year. Okay, you're not really getting this amount and this amount. So don't get tricked by those dealerships and salespeople when they say you can claim it all back in depreciation or in taxes. They're using the words to play around with it and then just trying to encourage you to buy it. So just be careful sometimes. Like most of you guys should know this already. But yeah, when you claim depreciation, you don't get the whole thing back. You get the percentage in taxes back. Okay. The downfalls of buying it in finance is that usually you have to put down a deposit. Still good. You still make a monthly repayment. You don't pay it outright. However, there's usually a need for you to put 10 to 20% deposit because they want to cover their asses if you can't afford to pay for it. Okay, there is responsibility that you have to manage the vehicle or the equipment. You have to repair it because you own it physically. Depreciation of assets, that could be a con. Why is it a con? Is because sometimes you just want to claim it as fixed payments. Some people prefer to just claim, when I'm spending the money, I just claim that upfront. Depreciation at the lower end of the life cycle, so in the last few years, you don't really get much back after that. So that's why some people say it's a con to have depreciation. Most people prefer it as a positive, but I just put it there as a con because I was thinking about it last night. And having to pay interest is also a con. So if you buy a car for 50K, most likely you'll have to pay at least $12,000 in interest in these days. And $12,000 interest means that you have actually essentially spent $62,000 for a car rather than 50K. So that's a con because you're spending more money. Okay, buying it outright. Buying it outright means you own it, you control it, no ongoing payments, no interest. There's also a lot of tax benefits, which is depreciation. You get to also claim the GST upfront. GST claim outright, which I didn't write down there, but that's something that you're allowed to get. The downfall is you spend the $50,000 if you were to buy the car. So yeah, there's a significant upfront capital outlay that you have to pay for to own the car outright. All right, responsibilities. Also, you got to maintain it, you got to repair it, and it also ties up business capital. So that it's basically the same thing as this. It's basically meaning that it might cause cash flow issues for you if you go and spend the $50,000 upfront. Could be all the money in your bank account. So examples, obviously, most people would finance a car. They least likely will lease it because it's a big purchase. They want to get a loan for it. They want to own it outright. They want to claim the GST upfront rather than claiming it per month. In Australia, it's not very common to lease or rent a car. It's actually more common to finance a car or buy it outright. Not sure why, but in America, I heard that there are options for you to lease it. Usually when you lease it, it's lower payments, but you obviously don't own the car, they take it back. And I think it's just a culture thing that Australia doesn't really allow you to lease the cars that quite often. Heavy machinery is usually financed because it's a big purchase. Could be 150K. You're talking about buying a crane or a truck or anything like that. In terms of leasing, usually it's forklifts, printers. And the reason why it's like forklifts and printers is because they're things that need to be replaced quite often, and you only really need it for a particular reason in your business. So you're happy to pay a low amount per month or per week, a fixed low amount, and then once you've finished the project, or you want to upgrade it because this technology needs to be upgraded quite often, they will usually then just give back the vehicle or the asset back to the leasing company, and then you can go to another leasing company to get another one that's more upgraded and better. So that's why leasing or equipment leasing is quite good for forklifts and printers. Honestly, most people will go with finance and buying outright. It's just how it is. People prefer to own the asset rather than leasing it off someone. Okay, but yeah, these are the examples where you would do it. Kind of technically, like software is something that you would lease. It's kind of like leasing, right? You pay a subscription where you get to use the asset or the software, and then after you're done with it, you cancel your subscription. Quite similar. Leasing is a similar thing with that. Buying outright, obviously, most people would do it for cars and equipment. However, there's a significant outlay that you have to pay for to be able to do it. Sometimes, like when you're starting your own business, which is like a gym, for example, you don't have the credit, you don't have the numbers to be able to finance. So therefore, you'll have to, significant outlay of like 200K to buy all the equipment outright. Good thing is you're going to claim it all. Is anyone buying a car or a asset anytime soon? I want to use like a real-time example.
Me, Daniel.
Yep.
We have already a fleet of 5 cars in my company, and I'm getting a new Ford Ranger
Okay, you're buying a Ford
uh,
Ranger. Yeah, perfect.
now
Which is a
for
Ute
in 4 weeks
in
of
4 weeks.
them.
Right. So let's say the car purchase is 75K. So a lot of people don't understand how much they're actually receiving in tax benefits. So I just want to kind of provide that example. Generally, when I buy a car, I don't even think about it as well. I have to admit, though, you should never buy equipment or a car for the tax benefits. It's stupid to do that. You should buy a car or vehicle or equipment for the benefits of the business to help you make income or to help you do your job better, not for you to save in taxes. That's silly. Okay? The car is supposed to help you make money, or equipment is supposed to help you make money. If you don't make money, then you won't get any taxes anyway. So that's the tax benefit. You won't get taxed. So a lot of people who are first time in business, they get sucked into buying like a very expensive car, and I've seen it happen so many times, where they just buy like, yeah, Daniel, you're not one of them. You're laughing, but you're not one of you're not one of them. But like you're making yeah, you're making losses, and then you go and buy a very expensive car because you want to claim it back in taxes, but you haven't even paid any taxes. So why would you, if you're making losses, you haven't paid any taxes. So therefore, you won't get any tax refund. The only thing you might get is the GST, which is 10% of the value of the 75K, which is 6 grand. But you're still outlaying this amount here, $68,000. Someone's going to have to pay for it. Yeah, you can get a loan for it. But if you can't, if your business isn't making money, then you're not going to be able to afford the repayments, the monthly repayments after, and the cost of the vehicle. So you probably have to resell the car like 6 months down the track. It's going to reduce your cash flow, and it's going to actually be detrimental to your business. So one quick note: do not buy a car for tax benefits. Buy a car for business decision, for you to help you make money, or for to make your life, your business more efficient. And that's the reason why you should do it. Okay. I hate it when people like do things like that. Like, oh, they say to me that, oh, my accountant told me to buy a car because it's good for tax benefits. I think it's silly. Like, there are better things to spend on, um, uh, for tax benefits than buying a nice fancy car. Cars go down in value, so You buy a car, roll it out of the dealership, you lost 10-20% of in the money that you spent. So yeah, sure, you got tax benefit for it, 10%, but then you lost 10-20% after that. So anyway, that's just my thoughts, in my opinion. So yeah, anyway, let's try to use this example. 75K, you get a claim GST back of 6,818. There's something called a car tax limit. Okay, in this case here, usually Ford Rangers that carry over 1 ton, they call it equipment and 100% used for business. And so therefore they excluded from car tax limit. So there's a car tax limit in Australia. So that means that if you buy a sedan, a family car that isn't really used for 100% for business, which means that you can't actually claim the more in depreciation. So for example, if the car, see how this car is worth 75K, let's just bump it up to $90,000. You bought a not a car, but not a ute, but just a sedan car. Let's just say, I don't know, what's expensive? Like a Porsche, like one of those family car Porsches, not the expensive ones. Let's just say you bought one of those and you bought it for $90,000. Your total car value is $81,000. You can't claim $81,000 in tax in depreciation. You only can claim $69,000. That's the limit. Okay. Just want to quickly advise everyone that if you want to get the best value of a car and get the full claim of it, you should try buy under the car tax limit if it's not used 100% for business. And usually utes, trucks, vans, they are considered all 100% used for business. Okay, the only thing that isn't really used 100% for business are family cars, like sedans, that passenger cars that carry like 2 or 3 passengers. Okay, if you're planning to buy a Porsche or like a Lamborghini, like one of those sports cars, the ATO will never see that as 100% used for business unless you're a car dealership. Okay, cool. So I just wanted to get that out of the way. So going back to changing this to 75K, that means that you get to claim the GST on that. Car tax limit doesn't get affected, so you get to claim the full amount. This is still under the car tax limit anyway, so that's fine. So you get to claim GST, but you also get to claim depreciation. I just want to show you guys the 2 options that you can claim. You can claim more at the start of the life cycle, or you can claim a flat amount every year for the next 8 years. Okay, so if you want to claim the small business depreciation rules, which allows you to claim 30% of the value at the start, you get a benefit of 5K, tax benefit of 5K for that first year. So by spending 75K to buy this car, say you buy it in June, you get to claim GST of 6,800, and you also get to claim depreciation of 20K, which ends up resulting to 25% of the 20K. You get to claim 5K. So that means that in the first year, you get a benefit of $12,000 roughly. So that's what you get. And just to quickly explain, why is it 25%? Because the company tax rate is 25%. So you only get the value of like how much tax you would have paid. If you claim depreciation, you would not need to pay that 25% on that depreciation. Cool. That's how that works. Okay. If you borrowed the money, that means you would have to pay interest as well. And I just did this rough calculation on, what the repayments are and what the interest is. And I just want to quickly show to you guys that a lot of car dealerships, a lot of finance company confuse a lot of buyers by putting an interest rate at 8% and saying that the 8% interest rate is really low. That's the lowest you get. But then they charge you all these monthly fees at our application fee, or credit card fees, or or transaction fee per month as well. But by doing that, that means that yes, you pay lower in interest rate, but then your fees actually go up, and then in the end, you're actually paying more. So the best way to calculate it is actually look at the car value, look at how much your repayments are going to be, and then work out the number of repayments, the repayment amount, and then find out what the total cost is actually going to be for you. So let me just give you an example. So on 68,000, say that you're borrowing for 60 months. 60 months equates to 5 years, and you're paying 1,500 a month per month, right? That means that the total cost of the car is not 68K. It's this times 1,500 per month. Okay, I've ignored the fact that you had to put down a deposit. Let's just ignore the fact that you put down a deposit. But then say the deposit is zero. It's never zero, but let's just assume it's zero. That means that your total interest is actually 21,000 for the whole period. So it seems like a lot, but it's because it's over 5 years. That's why. So every year you're paying interest, but you're slowly paying it down. So therefore, it's like about 21,000 in total interest. So you actually get a tax benefit for the interest that you get a claim that you pay as well. So you get 25% of that too. So overall, what is the actual benefit that you're getting? So when you finance a car, or when you actually let's start with outright. When you buy it outright, you get 25% of the value of the car as well as the GST. So the total value you're gonna get, Daniel, in your situation is $23,000 from taxes back. Not bad. Not bad at all. So you spending 75K means you'll get 50, like you're paying $50,000.
Sorry, David, I can ask you something?
Yes.
About that one, the $23,000, that one is for the a part of the GST?
Yes, including the GST. So the GST 6,000 you get a claim, 6.8 plus the taxes, income tax. So there's depreciation and income tax. I've excluded FBT, but yeah, because there's no FBT. Fringe benefits tax is the private use portion of a car. In the ATO's eyes, there is no private portion of a ute because they think it's 100% used for business. All right, so in your case here, but for finance, you get to claim more, right? The reason why you get to claim more is because you have to pay interest as well. So you get to claim 25% of your interest as well. So if you look at this formula, it's the interest times 25%. It's the value of the car times 25%, and it's the GST, 6,000. So all up, you get to claim 30K. And so therefore, the actual cost, it's going to cost you after the tax credits, 65K on the 75K purchase, plus all the interest and all the extra costs. Cool. Fancy little calculation. But like I said, shouldn't really matter. You shouldn't think about this really. You should be buying a car that actually makes you money. That's what you should be thinking about. And what does that mean? It's opportunity cost. Opportunity cost. So a lot of clients say to me like, oh, should I buy this car outright or should I finance it? Like, what do you think is better? Like, what's your opinion? Okay. So I can't give you guys financial advice, but the way I answer this question always is that what's the opportunity cost of you buying the car outright, spending the 75K out of your bank account instead of financing it where you get to keep that 75K in your bank account. You might have to let go of some of it for deposit and for monthly repayments. But what would happen with that money? So say you had that $75,000 still in your bank account because you financed the rest. So in this case here, you lose 75K upfront. Whereas here, you would still have that 75K. Let's just not say it's 75K. Say it's like 55K. So you still spend $20,000 for the deposit and monthly repayments for the whole year. But then you're still left with 55K in your bank account. So if the client says to me, I'll probably leave in my offset account, then that really means that they're really getting only a benefit of 6% returns a year. Returns. That's the opportunity cost. So if they spent 75K to buy this car, this is what will happen. They'll lose the 6% because they'll take it out of their offset account, put it into the business and buy that car. And then they'll lose 6% savings in their offset account. Whereas if they were to borrow the money, they'll probably have to pay 10%. That's usually what it is, 10% in terms of interest. So Daniel, in your situation, if you were to buy the car and finance it, you're probably going to pay 10% interest. So this is the opportunity cost. You saving 6% in your personal name or in your offset account, or you financing car and paying 10%. That is the opportunity cost. Which one's better? This one right now is better because you're only losing 6%. You're going to lose 6% if you spend the 75K. However, in your situation, Daniel, you are running a business. You'll probably need the car. The car is useful because you're carrying tools, and you need the actual ute to make money. So therefore, if you actually had a car to travel around the place, it'll probably most likely make you money. And there's no value that I can actually put down there that would say that it will make you like a percentage in returns. But we know, everyone knows here, that this car will make you some money. So that's why it's actually quite useful to take that in consideration as well. But if this car was not a car and it was like a heavy machinery, say it was a scissor lift, for example, you can rent out the scissor lift. Then you can go, all right, well, the scissor lift cost me about 50K. I can rent it out for $450 a day. So if I rent it out for, say, halfway, 150 days in a year, that means that it's going to make me 67,500. So that's actually like, you can calculate the returns on that. I actually don't know how much a scissor lift is. Maybe it's like $80,000 or something like that. So you can see that like this is actually going to make me more money if I were to. It's going to make me a return of this, for example. Okay, these are all made up numbers, but yeah, this is like 84% return. I don't actually think it's that much. Maybe it's like 250. Yeah, well, maybe it can make me 47% return. However, I haven't taken consideration. This is the cost. This is the return, but there's no expenses taken out of this. There's also expenses to run it. There's petrol, there's repairs, there's insurances, and I haven't taken that out. But say I take out another 15K for expenses, therefore it's making 28% return, then it makes sense to finance it because it's making me 28% return. It's costing me 10% in interest. So overall, it's still making me like 18%. I should finance it. Then instead of me paying 75K to buy this scissor lift that I can rent out, I can buy 2 scissor lifts because I can put a deposit down for one scissor lift, and I can put another deposit down for another scissor lift, have enough money to be able to make the repayments for the next 2 years or year for both of them. And both of them can generate a return of, 28%. Okay. Again, I just made numbers up, but just showing you guys how to make a decision on it. It's all about like opportunity costs and then, what's making you a rate of return and understanding the differences. A lot of my clients say to me that I'm just taking the money out of my offset account. It's like sitting in my offset account. And then they ask me, should I get a finance for it? Finance is 10% for a equipment loan usually. Your offset account is 6%. So technically, you taking the money out of your offset account, you're actually saving 4% in interest. If you got it in your finance, in your company or business, you're actually paying a higher interest rate. And the reason why you're paying a higher interest rate is because it's higher risk, because it's business. So that's why the bank or the finance company charges you more. You might prefer that though, as a business owner, because you don't want to, that money that you're taking out of your offset account is your own money, your personal money, and you rather pay the higher interest in the company because the company is the company's money, and if anything happens, that will go after the company rather than you personally. But a lot of finance companies are very smart. They make you sign a personal guarantee, just so you know. All right, so there looks like there's some questions. Can I buy a G-Wagon? Oh, that's a very good question. So G-Wagons, if no one knows, is a very expensive car. I think it's like 500K. And like Porsches and like, Porsche and like all those expensive ones, like this beautiful looking car here. This is like my dream car. I actually don't really care about cars. But when you see me buy something like this, I just want to let you guys know I've made it. I've literally made it because I'm such a tight ass. And if I'm a tight ass, because I'm an accountant and I'm buying a GT3, oh my God, like I can't believe I would spend something like that. Yeah, so I'm just letting you guys know that if I buy something like this, I've made it in my life. But yeah, okay, so real quick answer to this. It's a very silly idea to buy a G-Wagon or a Porsche or a very expensive car that is considered for personal use. Okay, you still get to claim some portion of it in your business, but the problem with buying that is because of that car tax limit. So the car tax limit is $69,000. So you can only claim $69,000 in for you spending 500K. So say you spent 500K for the car purchase, the ATO won't let you claim GST of 45K. The maximum that will allow you to claim is the 69,000 car tax limit. So from spending 69, 6, 7, 4, 6, it changes every year, so I can never remember. But they'll only allow you to claim GST of 6,334. Not that big of a deal. You get the car still in your company, great. But when you sell the car, and say you bought it for 500K, and say you sell it for 400K, try guessing how much GST you pay on the 400K. There's no car tax limit in reversal or for the sale. So there's no limit on the GST payable. The GST payable is that 10% divided by that divided by 11, which adds up to 10%. It's 36K. So you end up paying, they limit how much you can claim in GST, but when you sell it, you have to pay the full amount of GST. So the ATO takes more GST off you by you buying a very fancy car. Same thing happens with depreciation. You can't claim over the car tax limit. So you only can claim the 69,000 too, if it's a family car or sedan and it's used for personal use as well. So you only get to claim the 63,000 because it's 69 minus the GST. So the maximum you can claim is that. However, you spent $400,000. So they would only allow you to claim like what? You only get $2,000 benefit. So the answer towards that question is actually buy in your personal name. I know it's harder to get finance. I know it's I spoke to a accountant that's been around he used to be an accountant, became tax lawyer after that. And he now advises a lot of accountants. And he owns a nice fancy car. And I asked him the question. I was like, so what, like my advice is to buy in your personal name. What do you think? And he said, yep, 100%. If you were to buy a fancy car, buy in your personal name. If you can't get the finance in your personal name, or you can't pay for it in your personal name because you don't have the cash, then you can't afford it. Sorry guys, you can't afford it. Don't do it, because if you do it and buy it in the company, the result is you're gonna pay that. You're gonna pay for it when it comes to selling it. Also, don't forget there's FBT, fringe benefits tax too. So a Porsche or a G-Wagon, the ATO, they have this way to data match, and they will eventually check if you're calculating the fringe benefits tax. So that fringe benefits tax is 47%, and the way they calculate it is they calculate 47% on the value of the personal benefit you are getting on a car or a vehicle or whatever. So if the ATO finds that you've got this G-Wagon that you're using for personal use, which it's obvious that there is some sort of percentages used for personal use, that they would say that, okay, well, there's a rule where they just say, 20% of the value of the car is your personal use portion. So therefore, the ATO would technically require you to pay 47% FBT on the personal use portion, and they say it's like 20%. There's this formula they calculate, and they say it's 20% of the base value of the car. So therefore, they make you pay 47K in taxes. And the biggest problem about this is accountants are not very knowledgeable with FBT. They usually just avoid it overall because it's a separate tax. But then a lot of companies get hit from it when there's an audit, and the audit usually happens 3 to 5 years later. So let me just quickly go back to the questions, because I've noticed some quite a fair bit of questions. So considering, but potentially looking at selling off my private car to see if it's beneficial to put a vehicle under a company car. Yeah, so selling your personal use car in your personal name doesn't attract any taxes. And then when you buy it in your company, that means that you get to go through this whole process of calculating like depreciation, claiming GST. Remember guys, if you're buying it for a private seller, and an individual, they might not have GST on it. So you might not be able to claim GST on it. But if you're buying from a dealer or a business, they usually charge GST on it. So you get to claim that 10%. So you automatically kind of get a 10% discount when you're buying it from a business. Cool. So yeah, I recommend it if you really need the car and you need to upgrade because the car you're driving is gonna break down on you one day. Let's see. Okay, going back to questions again. So a car over 69 should be leased or novated lease. I never agree on leasing a car. Like I think it's a very bad idea to lease a car. Reason is you don't get to claim it upfront. You only get to claim the fixed payments per month. And also usually it's a bit more costly. In Australia, it's not that great. Like you don't really get a good price for it. The cost is like quite high overall because there's high risk for a leasing company to rent the car over to you. It's very similar to when you rent like Airbnb, for example. Like when you rent Airbnb, it's the cost of doing a long-term lease versus Airbnb. Airbnb is like what, double or triple the price for a day, whereas when you do a long-term lease, it's a lot more cheaper. Why is that? It's because it's high risk. Okay, sign a long-term lease. It's lower risk for the landlord. Same thing with the leasing company. They charge a higher value, and so therefore it's actually not that beneficial to lease it. Usually in Australia, it's actually not even that common. You can't lease a Porsche. You can't lease a Porsche for like 6 months or 12 months. It's not really that thing. If you do, it's very, very, very expensive. Because you don't own the car, so it's really high risk. You can just take the car and run. And the problem with that is there's a lot of criminals in Australia that rebirth cars. Yeah, so they just take it all to rip it to shreds and stuff like that. Okay, so novated leases and leases is not really that common in Australia, and it's probably not that recommended as well. If I lease, finance, or buy EV vehicle under the company for employee, would I be charged FBT without logbook? The employee would only be required to show. Yeah, okay, well, you already answered your question. Oh, you already know this answer. You're cheating here. But yes, EV vehicles have an FBT exemption. So I think it's just a special thing that is happening right now. But basically, if you buy a car that's electric vehicle, similar to you, not that similar to Utes, but Utes also get an exemption from FBT because it's 100% used for business. That's the way of how Utes get it. And vans, but there is this new rule where the ATO is the government's trying to encourage people to buy zero or low emissions vehicle. So they're giving you a discount in terms of taxes. So basically, if you have a car that's zero or low emissions vehicle, first time the car is being held after like 1st of July 2022, and it's used for a current employee or a family member of that employee, and it's under the luxury car tax limit. The luxury car tax limit is actually not to be confused with the car tax limit I said before. Okay, so the thresholds for luxury car tax is higher. It's actually 91 grand and 89,000, just so you guys are aware. Yeah, so it's actually a higher amount. Now, before when I showed you guys the car tax limit, it was 69,000. That's not to be confused with luxury car tax thresholds. Completely two different things. So you can buy a car for 80 grand or 91 grand, and it will be exempt if it's an electric vehicle, just so you guys know. So you don't have to pay 47% tax on FBT. There is like a cheeky way that at Box we do is like we make the employee or the director rent the car off the business and repay the personal use portion of it. Which is called a employee contribution. So some of you that do FBT with us would see it, but that's how we try to avoid FBT if it's not an electric car. But electric cars are exempt. You don't have to pay FBT on it. So if you're sometimes if you're a business owner and you want to claim as much as you can, you most likely buy a Ute or electric car. That's under the threshold. Cool. Yes, you do have to report it in your PAYG summaries in single touch payroll for that you've got FBT on an electric car. How do we determine the percentage of personal use versus business when reporting to the ATO? Can you show? Okay, so there's something called a logbook that you're supposed to do. It's a logbook method. And it's actually quite easy to do, guys. Like basically what you're supposed to do is you keep a logbook. I always forget how many weeks that you're supposed to keep it. I think it's like 12 weeks or something like that. Let me just try to, yeah, 12 weeks. Yes. So you keep a logbook for 12 weeks. And what you're supposed to do is you keep a log of the whole day's travel. So let's say you went to groceries, 5Ks. Then you went to you see a client, 20Ks. So you worked that out, and you worked out that 80% of that day was used for business, 20% was used for personal use. You do that continuously for the next 12 weeks. Once you've worked that out, that then gives you the percentage. Like you average it out. You've worked out what's business use portion percentage and what's the personal use portion. So this is kind of like the same thing. And you do that for the 12 weeks. You worked it out. Then you just keep a record of it, save it somewhere. You can do it on an Excel spreadsheet. Doesn't really matter. Or you can find an app that does it for you. Like there's apps online that does it for you. And you just keep a copy of it. That's all you do. And then once you've worked out the average business use portion, you file that for, I think it was like 2 years or 3 years. I think it lasts for 3 years or something like that. How many years? 5 years, sorry. So it's valid for 5 years. So you don't actually need to do a logbook again. Pretty cool, eh? So you can do one, you can find a date or 12-week period where you actually travel a lot for work. Do the logbook for that period and then keep it for the next 5 years. Technically, if circumstances change, then technically you got to do the logbook again, but you get how to kind of play around with that. What if I remortgage house loan as interest rates are lower, then finance and buy a car in a business name? Can you still claim the GST? 100% you can claim the GST, 100% you can claim depreciation because it's in the company name. You get to claim the interest as well. The only problem with that is that you're diluting you're mixing up personal loan with business loan. So it gets really confusing when you do something like that, because then you kind of show to the accountant every year how much your interest is and how much of the portion is. And it's very confusing. Say that you've got like $1 million loan and then the interest is on 6% of that. And then say that you refinance, you took out like another 100K. So that then means that your loan goes up like this much. It's 1.1 now. And so your interest is this. So now from the portion you took out was 100 over that, this is, and that's what your percentage, your business percentage for what you can claim on your total interest. So say that the first year you do that, you get to technically claim, you can't claim the full amount of the interest. You only can claim 9% because you only use 100K of that loan for business use. So you get to claim $6,000. However, if you then go and withdraw another 200K out to renovate your home, then it gets very messy. So now you have to keep a record of that, put that in, and then change this rate, because now it's not 9% anymore. It's like 100 over this. So now it's like 7.6. It dilutes the percentage, and the interest is this. And you kind of I can work it out off the bat quite easy, but it might be hard for you. So that's the problem that you have to kind of figure out. It dilutes the interest calculation on the loan. So you just got to be very careful. So you just need to be able to provide that information, keep records of it, that you took that money out and lent it to the business to buy a vehicle, that you can claim a portion of it. So keep a record, write a diary note, let your accountant know, write an email. When buying car under business, do we also get to claim any other expenses apart from depreciation benefits? Of course you can. Yeah, you can claim the fuel, you can claim the repairs, you can claim all the extra stuff that you buy on the car. I just excluded all that because that's usually just claimed as motor vehicle expenses. Yeah, I think that's all the questions. Thank you for your time, guys. This was very good. I actually really enjoyed this one. So anytime any guys or clients ask a question about, should I buy a car on the finance or lease or outright, I'm just going to send this video instead. No, I'm joking. I'll still answer the question depending on your situation. But now you guys know like a lot more information on what cars to buy and how to buy it.